Most investors will tell you that they're looking for great teams or big markets. That's bullshit.
I don't think that deals die because of the pitch. I really do think that deals die because investor doesn't believe the company can become venture scale.
What do you think investors wanted versus what you learned they actually wanted after you started writing checks yourself?
I thought that investors wanted great ideas and amazing founders. What they actually want is asymmetric upside with limited downside.
You've built companies through FDA, through HIPAA, and payer negotiations. What tells you a team can actually execute through that complexity versus just having a really great idea?
Expertise matters. You bring expertise. There are various creative ways to bring expertise without having cash on hand. There are different tools you can build into your agreement where you are able to bring the expertise that's needed to the table without paying cash today.
Safes, convertible notes, priced rounds. Most founders have no idea what they're actually signing. What should they actually be negotiating for that they often leave on the table?
Liquidation preferences in particular can completely reshape an outcome of an exit. Founders should really understand something simple. Your cap table determines who gets rich when the company sells. And sometimes the person who worked the hardest, the longest, who started it all, is not the one who gets paid at all or meaningfully.
Most investors will tell you that they're looking for great teams or big markets. That's bullshit. Or at least it's kind of an incomplete story. My guest today, Alexandra Hirzel, started her first business at the age of 8 in a Siberian town because she really wanted a pair of shoes and her single mother couldn't afford it. And I get that. She moved to the United States with $320 in her pocket and has since built one of the most beautiful digital health companies, exited multiple times, and now invest in the same spaces from Switzerland. Alexandra sits on both sides of that table as a founder as well as an investor. She knows what it actually takes to get funded, what kills deals quietly, and why most founders waste months pitching to the wrong people. This is Confluently, where we talk about power, money, and influence without the sanitized pitch deck. Let's get into it. Alexandra, welcome to Confluently.
Hi, so happy to be here. I'm here in sunny Switzerland in the French-speaking part, but don't test my French.
Don't test mine either. Many years of school and I still can't speak it. Let's start off with some hard truths. What's the number one reason why deals die that founders never see coming?
Well, I don't think that's most deals. Well, I don't think today that's the caveat because I flipped tables about 5 years ago. So today, I don't think that deals die because of the pitch. I really do think that deals die because investor doesn't believe the company can become venture scale. And founders usually think, is this a good business? And investors think, can this return my fund? And if the answer is no, the deal is already dead. You might just don't know yet, but it's dead.
Absolutely. Can they return that capital that I have invested? When you were on the founder side, raising capital, what do you think investors wanted versus what you learned they actually wanted after you started writing checks yourself?
Well, I thought that investors wanted great ideas and amazing founders. And what they actually want is asymmetric upside with limited downside. So what does that mean? They want to see that the market that's massive, you can dominate it, and they won't be dump money at the table. And everything else, the storytelling, the vision, the charisma, is just the packaging.
We'd love to stay in touch. Hear that all the time from investors. If you're a founder, what does that actually mean when an investor says it?
I mean to know. And in fact, what I wanted to say is the good thing is you are hearing that. So there is some sort of level of respect or politeness. But I'll tell you this, as a founder myself, pitching, and pitching is a numbers game. At least you heard we would love to stay in touch. Because I used to get frustrated because sometimes you hear nothing. And you just, like you send your email and you feel like you're wasting your time, you're pouring your heart out there, but you just don't hear anything. So, I mean, it just means no, but just very politely. Now, once in a great while, if something materially changes, oh, luck. So it means that there was something that they like. The answer is still no, but let's say you close a few large deals, and usually here's the caveat, because it's always a sales, right? You're selling to investors, you sell to customers. So if you close a customer, that doesn't mean something materially changed. And even if it's a large customer, investors are still thinking, yeah, it's a risk. You closed one deal, it took you like this long. But if you closed a number of customers, so maybe something else had changed, like an R&D or whatnot, then ping them back.
How do you get investors to tell you the real reason why they're passing? That's, I think, one of the most credible feedback you can get as a founder. How do you get that feedback?
Well, you've got to ask for it. You think that people do. And as a founder myself, I had learned the hard way. So some early in my career, you just say, thank you so much. I'm going to ping you back. And again, there is a reason why I just said something that's materially, valuable, that then you should circle back. But otherwise, I see a lot of sort of like, thank you, we will stay in touch, blah, blah, blah. But people are not asking the question. And sometimes, again, before I'm an investor, I'm an entrepreneur. So sometimes I just volunteer, like, hey, do you want to know why I said no? In fact, I was just recently at a conference last week on Thursday, and a founder, amazing founder, we've chatted. And by the way, I love that she's a female scientific founder. She was taking notes and everything, but in the end, she didn't ask the question. So, do you want me to tell you why I'm the class? And she was like, yeah. And I was like, so I love everything. I don't do B2C. She was like, huh. And so I was like, I have no objection with, the science, that, the market, I just don't do B2C. And I told her the reasons why. As a founder, I never liked it. And why as an investor, I pass. So anyways, you want to ask the question.
Always ask the question. The second question I think that a lot of founders also pass on is, you know what, this may not be the right fit for you. Fair enough. Do you have two or three other people that it might be a fit for? Do you mind going through your Rolodex and coming back to me? How many founders actually ask that question? And is that a good question?
Some people do, yeah. Yeah, some people do. I think that it's really natural for an investor. I'm an angel. I work with funds, I work with family offices. So if I see a deal and I love it, but sometimes the valuation is not there for me to meaningfully realize the upside if there is an exit. But I love like all of these other things. So then I actually offer. I say like, hey, I'm working with a few, funds or family offices. Let me make an intro. Other times, again, I'm trying to be really respectful, because again, as a founder myself, sometimes, especially as a female founder in deep tech, people are just mean sometimes. If I haven't offered, it's because I haven't said it, but maybe I just hide the deal. Or maybe just don't think you have the expertise. Maybe like you're an amazing scientist, but I don't think you can scale. Or maybe I feel like the science is missing, like whatever the deal is. Like I might be polite, you might not. If you're not asking me, I'm just gonna say, hmm. And then if you say like, hey, can you introduce me to your friend so and so? I know like on LinkedIn you're connected, like they're commenting on your posts or whatever. If I haven't offered, I mean, you're not offending me by asking, but I probably will not, if I don't like the deal, if I haven't offered, I probably will not pass it. But you can ask.
I think maybe it's best practice, right? I mean, it doesn't hurt to ask. You may or may not get the answer that you want, but always go for it, because if you don't, then you're missing opportunity to potentially make the right connection. Um, Safes, convertible notes, priced rounds. Most founders have no idea what they're actually signing. What should they actually be negotiating for that they often leave on the table?
I love this question. It's really practical. In fact, I'm being asked so many of the same questions when I work with founders. And so I've actually been publishing quite a bit lately on LinkedIn, so you can look at this. But I think the focus is usually valuation. And some founders really lead with that. Like, I will only talk to you if you agree with my valuation. Oh, really? Then we should not be talking, honestly. But to tell you the truth, practically speaking, valuation is probably the least dangerous term in a deal. What actually matters are things like liquidation preferences, participating versus non-participating structure, pro rata rights and follow-on capacity, who the investor is. Liquidation preferences in particular can completely reshape an outcome of an exit. I've seen so many stories, and in fact, I've been affected myself as a founder. But mostly I've seen some crazy stories, especially when I was living in San Francisco area, where founders work really hard, crazy exit, like a lot of zeros, like everybody in the founding team is excited. And then the reality is they end up walking away with very little because the stock preference consumed most of the proceeds. And that's it. So founders should really understand something simple. Your cap table determines who gets rich when the company sells. And sometimes the person who worked the hardest, the longest, who started it all, is not the one who gets paid at all or meaningfully. And beyond the legal terms, I'm just gonna continue with this because it's a really important question, right? Um, the investor is really important. Their full-on capacity. Like, for example, there are some deals that I, as an angel, had passed on because I just know I cannot follow. And I know that's especially in healthcare space, like medical device exits are moving further and further along. And sometimes I can just see like we're talking exit like 12 years plus, maybe more. And I just know that's not the deal I want to participate in. So just make sure you understand that as a founder. Again, with investors like network, can they help you not just with investor introductions, but sales, pre-sales, LOIs, this stuff, different customers have sales that matter. Reputation that with other investors. I know you get, as a founder, you get sometimes a bit desperate, right? You need the money and just think any money is good, but I think smart money is better. And you always want to think like this is a long-term relationship.
Yeah.
And I think 5 years plus in some instances. Just think of that kind of a bigger picture. Now, I want to touch base. I know it's supposed to be one thing, but I want to touch base on valuation. I also recently published a post on this because I'm seeing so many deals where sometimes maybe I like the product, I like the founder, but the valuation is not reasonable. And I've actually have passed on that. I've passed on as an investor. There was recently, just in the last, I'd say 3 or 4 months, I said no 3 times for the same reason. Like the science is okay. I think there is an opportunity in the market, whatever. Valuation is so crazy that I, as an investor, I'm not gonna put my reputation at stake here. I just know for a fact that with no traction, okay, even if we have a decent product, but no traction, if the product is fully like a SaaS, right? No device, no traction, the valuation, let's say like 30, 45 million, no revenue, it just doesn't make sense. Because if you look, you have to understand as a founder, right? Investors think about an exit. And so when we think about an exit, we're doing comps, right? Competitive analysis. Who had exited in the space in geographies? American base exits are larger. And we think about all of these different variables. And so then we take sort of an average because we're guessing, right? You're guessing, we're guessing. And then if I see that mostly like the exits for similar tech is around like 45, 50 million, here you pitching me pre-seed or seed stage, no customers, and you're like, yeah, my valuation is 60 million. And so you're just sitting here. I mean, sometimes I just say like, okay, no. Sometimes, recently I worked with the founder for forever and he offered me an amazing shareholder opportunity as a board member, and I still said no. It just no. Understand the exit, right? So understand the numbers as a founder, and understand that there are a couple of things, because in all of these situations, these particular founders sometimes had fundraise from friends and family, and this is where your previous, expertise, maybe you're coming from an industry, right? So it matters, and you had the relationship, so you found some believers. But the thing is, to scale, you need to find institutional believers. And, people don't know you that well. And if they're looking at that, it's a numbers game, right? So you're just like, okay, you can be awesome, but it's just numbers don't make sense. So valuation is important. In fact, there is more to this. I wrote a post about it, but there's just sometimes
Link all the post at the bottom of this so everybody who's listening can go ahead and follow along on the journey and the information that you have been shelling out. I have to tell you, a wealth of information. I know that some years ago, so, I've been in the industry for quite some time as well in financial services. It used to be a 5 to 8 year exit, is what most, investors wanted. Is that still the sweet spot, or should, founders really be reverse engineering it for a different time period?
I just really think this depends. So mind you, like my first two exits were not in medtech, so they were a lot quicker. In medtech, you have so many subverticals. Are you a SaaS? Are you a medical device? Are you like in digital therapeutics? I don't touch on pure pharma, but those are like could take forever. Um, it really depends. It really depends. So I could tell you this as a founder myself, like for me, like a 10, 15 million in ARR, I was always like, okay, usually 10 million, like 7 or so million, like you start getting term sheets. I mean, some of them are not amazing, but you get term sheets. And so that just depends on the founder and expertise. Like my last one, I mean, it took 14 months to reach 50 million in ARR. And so it really depends, right? So I don't have like a straight answer. It depends. But I could tell you this, that no matter the industry, the exit time now for a number of reasons, it's taken a bit longer than even like 3 years or 5 years ago.
That's really useful information. You've exited many companies and now you invest. What is the biggest mistake that you made in your first fundraise that you would hope that the founders community does not repeat, but constantly does?
Kind of a lot of questions. I think you like talk to investors too early. You're not prepared. And the reality is sometimes you only have first impression. And investor community is quite small. And I had realized that when I was living in San Francisco area. And so you go to these events, you're pitching and you see like so many faces. The reality is like they're all like texting each other. You could be pitching and hey, like there's a group chat, like so many people had talked. And then sometimes you see there is like there are several people coming at you, although they were quiet, there was no Q&A from them, but someone had asked the right question. So it's a really small community. So like first impression is super important. Don't come in too early. And another thing is sometimes, and I'm dealing with this as an investor, right? So I recently put out a mandate for family office. And it's very specific. There are a few things there. One of them is revenue of 1 to 10 million. That's it right there. And I led with that. And so I'm being approached by founders like, oh, we are, we're amazing. We're da-da-da-da." Like, do you have revenue? No, we're pre-revenue. Like, that's not part of their mandate. So I think what we also have to understand as an entrepreneur, like we interviewing each other, right? So we want to have like a good marriage here. And I'm an angel and I have a strategy of how I deploy capital. And VCs have their strategy, family offices have their mandate. So you have to check, like before you start a conversation, you just have to check the boxes, right? And it's revenues, geographies. Like, okay, you could be pitching a deep tech deal to some niche, to a generalist fund, and you're so niche, and they just simply don't understand the value because they don't have the technical expertise. So you really have to sort of interview each other. And I mentor entrepreneurs, and they say like, okay, you have first impression, sometimes only impression. And investors, like we have all a network, we take friends with us, right? So when we like a deal, and so make a good impression, and like also interview us, like start with like, do you like what space do you work in? Like what do you like revenue, geography, product, R&D pipeline, like exit expectations are super important, like questions like this. And I think for me, I had to learn, I think somewhere in the midst of my career where I'm like, okay, I'm just saving time for myself. Like before I pitch, I say like, hey, 5 questions, super fast. And it's like takes 10 seconds. And then you say like, okay, it was nice meeting you, but like not an alignment. Or like there is an alignment. Let me pitch you.
I love that. I think that asking for the thesis, straight out the gate is really important. So, like you said, it doesn't waste anybody's time. My question is, what is the real traction bar in 2026? How much do you actually need in order to like get off the ground if you are a seed or pre-seed company that wants to hyperscale?
I really depends, right? So I like to say that I want to see an MVP. Like I don't want to look at I want to see at least a demo of a working product if we just see, doing SaaS B2B. But ideally, I want to see revenue. And if the company is not in the healthcare space, I really want to see revenue. In the healthcare space, sometimes it's a bit of a chicken and egg. So I'm respectful to timelines for revenue, like an LOI. Sometimes that's awesome. It's sellable. But outside of healthcare space, right? So some revenue. Um, Strong retention is really important, actual customer pull, but depending on what you're doing. So again, nobody's writing checks for like wait lists anymore, or like just a hype. And if you have a demo and if you're not in a heavily regulated industries, like go sell. Whatever you build, go sell. If you're in a regulated industry like healthcare, it's a little bit different. But otherwise, honestly, I want to see customer sales more so than I want to see an investor lead or whatnot.
Absolutely. Thinking about that technical component, right? AI is really eating up everything, in investor calls, in annual meetings. What is it? AI is actually, said more than, shareholder value at this point, right? At 320 billion going just into infrastructure alone. You've really written about whether this actually helps patients, specifically in the healthcare industry, or it just creates an arms race between payers and providers. How much of what's getting funded is real versus the actual hype?
Well, so I've been in the AI space before we really had AI. It was sort of like a fancy data science like 15 years ago.
I do. What is it? Yeah, we called it machine learning back in the day.
Yeah, but it was about charisma, right? So how we talk about the market, the temps and so on. Um, so I think a lot of the stuff that I'm seeing right now is actually features pretending to be companies. And, the simple question, and I know it sounds super simple, like, okay, how complicated it is for me to use a tool like Lovable and create something similar. So I want to say that probably real companies, especially in the AI space, they should have exclusive data sets, distribution, workflow integration, in the healthcare space they have to respect prescription patterns, workflows, so on and so forth, switching costs. And if your mode is just prompt an API, it's probably not about it's a demo. And
I love that. What kills deals quietly that you never tell a founder directly? Like you got pitched and it was absolutely terrible, and you'll just be like, nah.
you know what I actually see? Like sometimes the diligence starts to take too long.
That
And
that
not
that that is a little bit suspicious. Yeah.
So because here's the thing: if investors like a deal, they can just rally up, and if you also like, you have to be in the right cycle of the funds. There are all these things, but if the timing is good, right, they will rally up and they will write you a check. But I think it's a loss of conviction, and sometimes again. You hear something that's positive and you get into DD as a founder, and then DD becomes instead of 3 weeks, where they're like 6 weeks or longer and whatnot. And so I think you have to get a signal. And how do you build out conviction? I firmly believe that customer sales is really what often investor needs, right? So the market needs to be big enough. So it needs to be because every time you have a question that's unanswered, investor thinks that's risk. That's risk. They haven't figured it out. You don't have to have a perfect answer or whatnot, but you have to have some big things have to be answered, right? And so loss of conviction, there are a lot of different parameters here. So ask as a founder, like again, if the D is taking longer, or if you feel like email return becomes a little bit too stretch, right? So what questions am I not answering? And maybe you've lost them already, but maybe you can answer something, right? Because ideally you want to meet investors in the situations where market is huge. It's either you or someone else, but like someone has to solve this problem. And I've learned this as a founder myself. Um, you don't want to lead with, oh, like I'm first to the market and did it. First people usually educate the market. So it's actually from an investor perspective, like that's education is expensive. And I think, but again, I had to learn this firsthand as an entrepreneur, I had to do this. Now I like to say, actually, competition is great. And so, just see if there is a loss of conviction, if you feel like communication is being stretched and whatnot. Like, so what questions can you answer? How can you make them believe that there is an actual problem? There are others trying to solve it. Market is massive, and there is an upside opportunity, and you've got the solution, and you have a customer, and hopefully you sold onto a customer.
I absolutely love this. Thinking about the marketplace, right? 2021 was insane for deals, right? 2023 was brutal. Where are we now? Is there still dry powder, or are VCs really sitting back on their hands? We just heard about Apollo today, limiting withdrawals. Like, what does the marketplace look like right this second?
There's still money. There's still money to deploy.
There's always money. There's always money.
That means there is always money. But what I'm seeing as an investor, so I get pitched a lot by a fund, by different funds to come in as an LP. And the pitch is usually the same in the healthcare space. Like, hey, we have this ton of stuff that we had invested in. So now we are fundraising like a fund number, whatever, X, Y, and Z. Actually, it's not for the new deals, it's for the old deals because exits are taking longer. So I want you as an entrepreneur to know that this is, us investors, we're feeling the pain. Like we need some exits. We need to, make a little money to reinvest the money. And it's just the timelines for a number of reasons, including like political instability. Like look what's going on in the world. No matter where you are, you're feeling it. And so investors are feeling it too. And so like you're just more careful. You have to follow on not to lose the companies you supported. And so sometimes all the capital goes there. And again, as a founder, you can actually take that piece of information and kind of reframe how you go about fundraise, but there's still money. Now, I do have to say, because did bring up a few years ago, like mental health, like we overvalued mental health during COVID. We like overfunded it, crazy. Like we talked about valuations. There was some like insane and reasonable valuations at the time, and the investors lost money. And now you have some investors say, "Oh, mental health is, it's not great. It's like not making money." No, it's not that it's not making money. You should just come in with some sort of understanding of an industry as an investor, because you had people who were coming in from other industries and they're like, "Oh, healthcare is great." Healthcare is heavily regulated. You have to understand how we do business in healthcare, right? The timelines are different, regulatory, the clinical, a lot of different things. And so, there is still money. And if you want to do in mental health, something innovative, there's still, investors follow the pain, but there's still money. You just have to come in. You just have to understand, like, okay, you have to de-risk some of the unknowns. And, you could do that during the pitch. So yeah, prove discipline and clarity, not just potential, is what people want to see.
I'm on a lot of WhatsApp groups, right, for investors, founders, and so forth. And, ultimately, they're all just looking for the same thing, right? As you said, young, smart, excited, ambitious, looking for the checks, right? Who's actually writing those checks right this second? Is it family offices, VCs, corporate ventures? Where should these founders that are looking for money really be looking? Or maybe even angel investors?
I mean, everywhere. You want to look for it. So I think this is a question that I get asked a lot. And I think it's going back to understanding how investment works. So you have angels. Talk to angels when you are early on. And then you have family offices. Talk to family offices when you're early on, even, depending on the fund. Like there's one fund I work with that, for 100 million in annual revenue. So you can talk to them a little bit later, right? And sometimes with family offices, they give you a little bit more benefit of doubt, especially if you have a scientific background. They're giving you time. VCs are upfront with their timelines. So to talk to them as well, again, understand their strategy, investment strategy, and so talk to them. So help them tick off the boxes, right? And then you have private equity. These are the most aggressive in business. They come in with their own expertise. They're looking for quick exits. And they're very upfront. And there is no confusion. And as a founder, again, sometimes you get a bit desperate. And it's not that I'm judging it. Like I understand it completely. Like you have timelines, you have payroll, people on payroll, and time is literal money. And you have to understand, don't assume that somehow, some way you can later on buy some flexibility. I think if you understand that, time frame, first of all, right? Time frame, if you understand the deal terms, which we touched on in the beginning a little bit, upfront, then you know what you're getting into. But I think you also, again, depending what the stage of your innovation is, you have different types of capital that's available. Like I'm in Switzerland now. We have phenomenal grant opportunities here. Like in United States, they're very limited.
Yeah,
And you have
especially now
especially now, yeah, especially in healthcare.
in healthcare. Yeah.
And in Switzerland, you can fundraise 2 million in grants. Like it creates its own problem. That's not what this podcast is about. We won't talk about that. Like people like, oh, I am just, never gonna make money. And you're like, okay, why are you talking to me? I'm here to make money. Right. So, but the responding out there, depending where you are. So you just need to kind of overlap your maturity stage with, and then you understand what groups are there. But there's the
Here's an off question. Should founders give equity to advisors to open doors, or is that kind of a waste?
No, you should always have advisors. Okay, so this is a very practical way. I also had to learn it. So my first company I went to fundraise with, I had this amazing advisory board. I gave them all equity, whatever. We never really talked. But I mean, they looked amazing on my deck. And so I just thought like, okay, this is great. This is what I'm selling. I'm selling myself, my expertise, as a serial founder already. No, you're buying expertise you can't afford. And sometimes, you can't afford it because you don't have the cash to pay these people. Other times, like these people are so busy, they only have this limited time opportunity, but they have the expertise and the network you want. So you're paying for that as a founder. So all of these people absolutely understand that they are tied in with the air. So they're trying to move the boat towards an exit. And if the exit doesn't happen, everyone just wasted their time, and time is money, and wasted the expertise. And also, there are only so many, introductions. Even if you come from, let's say, like a rich corporate background or entrepreneurial background, like myself, if you make in too many introductions, but they, let's say, don't lead to something meaningful, like a meaningful industry impact, like let's say it's sales. I don't want you to always think that, invest introductions, right? But like, let's say sales, right, in the corporate world. And it's not leading anywhere. Like you also then as an advisor, as an expert, um, like on a second guess, if maybe you should evaluate how you're looking at all of this, engagements that, maybe in front of you, right? Or maybe you should pause altogether because you also have a reputation to maintain. So as a founder, basically what I'm trying to say is you need to know what your to-do list is, then you need to match that with expertise. And you bringing on board to an advisory board expertise, and you absolutely pay. Like in my case, I have so many opportunities and there's so many reasons for that. Not only I take equity, I also take cash.
Right.
And there are some advisors out there, SMEs have seen they only take cash, they don't want equity. Those ones I have an opinion because as a founder I wanted to for someone to be invested with me. And so again, as an advisor, I operate in a similar way. But so the answer is yes, but use those people. Don't just have them on deck. Use those people and make sure they all know each other. Some of the best boards I'm on, the board of directors, board of advisors, they all know each other. They network among each other and they help you. They help the management team to move the needle further.
That makes sense. I'm getting them all swimming in the same direction and not hating one another. Although I find sometimes that is quite difficult if you have a room full of very intelligent people that are very specialized in their own industry. Um, you've built companies through FDA, through HIPAA, and payer negotiations. What tells you a team can actually execute through that complexity versus just having a really great idea?
I mean, you have to have the expertise. And I really do believe that it's unreasonable to expect for the founding team to have all of the expertise, especially in regulated industries. That's where your boards come in. Now, to what you just said, because it is true, and sometimes now I'm in situations where management teams ask me to join, like let's say I'm an advisory board, but they want me to join a board of directors meeting as an observer because what they see is I'm able to observe the dynamic. And sometimes I can tell to the team, like, actually, I think we have a problem. I think we had lost confidence of our lead investor that was supposed to do the breach or like, lead the next round. So we've got, I don't know, we got to give them what they need. We got to answer some questions. We got to do some more sales. I don't know, like R&D has to, like, whatever the answers, maybe we need to take them for drinks, to kind of build that relationship, right? So I'm able to observe that, but I deviated a little bit. So again, expertise matters. You bring expertise. There are various creative ways to bring expertise without having cash on hand. There are different tools you can build into your agreement where you are able to bring the expertise that's needed to the table without paying cash today. You know,
Flipping the tables a little bit on the investor side, what are some red flags you see in the industry, specifically around them chasing money or deals within AI or other type of buzzwordy agentic agents at a bubbling water company? What do you see are some red flags that investors really should be looking out for? so that they don't, throw money and waste it.
I mean, the simple one is like sales. Someone is pitching and it's like really buzzwordy, and you start, I have a technical expertise. So then you start asking technical questions and you're like, hey, I don't like, I don't, yeah, okay. It's like, okay, so you don't know how your tech works. Okay. You don't have to be the CTO of the company, but at least you have to have some an idea of how you're executing. And then if you like anything agentic, whatever the buzzwords, um, those are not time proof to my opinion, right? So what can de-risk the investment? Well, sales can. And I'm not talking about investor sales because we had seen there are so many examples where, and there was the charisma and the packaging that we talked about earlier, and the founder was able to close under some absurd valuations. But later on, if the market is not big enough, if the sales are not happening at the rate that they should be at this valuation, I mean, that's all you got to know. So I think if you strip all of the buzzwords in this, right? So do you have a problem? Is the market large enough? And like, can you show me that by saying like, here's my list of companies and here's my revenue. Then
Absolutely. Give me an example of a company that you passed on and later became a unicorn and you kind of regret it, but what was the red flag and why?
I don't have that. I don't know if I'm chasing unicorns, to tell you the truth. I'm an angel. I'm looking at meaningful traction and I'm super, super practical. I've linked for exits, build that conversation into go to market. So I'm not looking for unicorns. So for me, like evaluation of, in the healthcare space, anywhere north of 50 million, like I feel like that's a win. And especially if we can execute on that timeline within 3 to 5 years, I think we're okay. And as a founder myself, like it can be perfectly fine, right? If you're not the unicorn. So I'm not chasing unicorns. I don't have an answer to that question. But I do have like in reverse. I have invested in companies where I thought like that could be huge because the tech is like, wow, there is so much IP. Not IP where founders sometimes say, we have this IP. You're like, okay, have you been awarded IP? Because otherwise you don't have IP. Especially in the software space, right? So it's complicated to patent. And so, but I've been in situations where there's actual IP, there are actually patents, and then there is a R&D pipeline of IP that's like super impressive. And you think like, okay, wow, that's amazing. And then as the time goes, you just realize that the founding team, the management team, maybe the board, they were missing commercial expertise
Mm.
that's required for this to scale, and you still believe, you still try to push. And this is where actually, as an early stage investor, I had realized that it's not just money, it's expertise, it's network. So that kind of flipped my strategy. And today I say like, okay, if you want my money, like I'm coming to, like I'm taking a board seat, I'm getting to know you. I want to help you with sales. If we had a tinker with product, I'll help you. Like I'm not your employee, I'm not your like co-founder. But I'm there for you because I realize that I'm de-risking my own investments. Not that I'm nice. I am nice. I'm de-risking my own investments because you really have to have all of these factors come together for the company to scale.
Yeah. No, I'm a big believer in that you do it for the client on the other end, which of course makes it profitable for you. That's the reason why you put out a good product. I mean, it's very simple. It's, Adam Smith going all the way back, not a complicated idea. You as a person, you went from that $320 in your pocket, landing on New York, the Big Apple, to big exits and writing checks. What are some of the particular skills, like personality traits that you have that you find make you successful going forward, especially in female founders, especially in tech spaces? What are those key traits that you're looking for?
I'm going to quote my mother. She said three things. It doesn't matter what you do. Consistency, persistence, hard work. That's it.
I love that. A lot of people are not into working hard these days, I hear. So,
I
um,
actually, I don't know if I agree with that. I think when I hear like someone like Kim Kardashian saying that, I think she's saying it about other fellow friends who are coming like from this really affluent backgrounds. So I really think this could apply to those people. Okay. And for me, I could tell you, like, that's not my background. Everyone worked super hard. Everyone went to university, like, got awards and were too smart, like scientific backgrounds or healthcare background, like my mom, and nobody made any money because I grew up in Russia. So, and then America, when I came to the US, I saw ton of hardworking people. So I don't know if I fully, and we could disagree on this, right? I think if you don't come from this affluent background, you really have to work, and especially like in United States, I don't care what you're doing. I don't care if you're man or woman. Like, you've got to work to achieve, because nothing is handed to you. I think this is a misconception that people have. Like, oh, you just come to the US, and then all of a sudden you have this crazy competition. There are brilliant people out there, and you've got to, just like a founder pitching. Like, when you have, I don't care if you're coming from corporate background, you got to pitch your expertise somehow, like elevate yourself, especially as a woman. You cannot elevate too much, because then you're like aggressive, right? You have to find this sweet medium, and but like, you got to work at that. So I think that Americans are really hardworking people, like as a nation, as a culture. And I think this people like, oh, people don't work. I think this applies to minority, but that's my personal take. And I think another thing is, you always having to work. Like, for me, I come from a financial background where that was my sole goal, actually. I wanted to be an entrepreneur when I grew up. And you know what? Somebody once asked me, like, so what are you going to do? And I was like, I don't care. Just want to make money. So, so for a while, that was the objective, right? So how do I get to this comfortable financial situation? And so I was willing to do whatever, teach myself million skills and work and outwork others. And um, so yeah, at some point it flipped, but I think the work ethic, it doesn't matter how much you have, like the work ethic, it's really like it has to, because they said, like, what would you see, what you look for? You have to have work ethic to survive in corporate world. If you want to transition, you're gonna need to have work ethic, maybe even more so, because you have to always teach yourself new things. Consistency, persistence, hard work.
I want to say what my grandmother always taught me, which is you're going to have to work twice as hard to get half as much as a man. So just keep grinding. Alexandra, thank you so much for the unfiltered truth and for the incredible insights that you provided to all of the watchers and listeners to this podcast.
Tiffany, love having this conversation. Love your energy, and cheering for you from Switzerland to all of your entrepreneurial endeavors. I mean, there is a lot that's unfolding. So, just here watching, cheering. Let's go.
That's it. That's Alexandra, founder of the Scale Foundry, an investor, digital health, AI, someone who's actually will tell you why you're not getting funded instead of just saying, stay in touch. If you're fundraising or this conversation gave you some form of a roadmap, go fix it. This is Confluently. See you next time. All the links will be at the bottom. Until then, I'm out.